Wow, that was quick. I am already live. Let me know if you guys can hear me already. I'm ready to get started. It's been a long day. And just as a reminder, guys, the super chat features are on if you feel so inclined. Yeah, anything you guys want to ask, you go right ahead. Okay. Let's see if everyone can hear. Excellent. All right, guys, ready for questions. There was a lot going on today in the markets, a lot of stuff that really wasn't all that obvious, and some big news. And depending on kind of how your feed looks on the news sources that you check out, you may have seen things that were different than I did. I saw a lot about VW today, and a lot of things that are going on with VW that are going to affect the market as a whole, at least the EV market as a whole, and a lot of things that are going to affect technology investing here in the future. So yeah, a lot of interesting things, guys. Any questions you have, though, feel free to ask. I'll answer any questions you guys have about retirement planning or taxes, anything that I can answer, I will. And if I can't answer it, I'll just say that I don't know. All right. So go right ahead. Shoeless Joe, welcome back. You are a frequent commenter on my videos, and I'd like to say thank you for participating. If you guys don't know, when you guys like the videos and you comment on the videos, that helps get them pushed out and seen by other people. And so I do notice the frequent commenters, and I wanted to thank you very much. Excellent. And then Mazar H, thank you for answering my question that you guys can hear me. And yeah, so why don't we start off by talking about what I made my video on on Sunday. I made a video about IPOE or Sofi. It's the window for to get into Sofi before they go public, via the SPAC IPOE. That window is closing. Supposedly, they're supposed to finish this merger by the end of Q1. The end of Q1, folks, is the end of this month. Now, you don't generally get a ton of warning. There's not a lot publicly said right before they end up going public. So I don't know when exactly they're going to go public. Nobody knows what that day is. But I'm saying to you guys that window is closing if you were looking at getting into the SPAC before they go public. Now, whether or not you should is an entirely different question. I would suggest that you check out my video that I did on Sofi on Sunday to understand the breadth of their operations, the finances that they already have with their company. One of the things that I noted in the video that a lot of people don't really understand when it comes to SPACs is that all of your fintech SPACs are in immeasurably better shape than your electric vehicle SPACs from a financial perspective. All of the fintechs that are going public here in the next year, they already have revenues. They already have products that they're selling on the market, and they already have proprietary technology. They already have maybe their area of specialty or expertise where they dominate. This is unlike a lot of the EV companies we're looking at right now. Like Canoo basically has no revenues at this point. I'm bringing them up because I actually like the company, and I actually like them more than when I first covered them. Or if you're looking at Lucid or somebody like Lucid Motors or somebody like Nikola, they have zero revenues at this point. Lordstown has zero revenues at this point, and yet they have valuations that are absolutely stratospheric. So IPOE, Sofi, and Cash app, which is run by Square, and there's a couple of other companies that are coming online. All of these that are going public this year, like I said, and this is going to be the year of fintech SPACs. Last year was the year of EV SPACs. This year is going to be the year of fintech SPACs. I think we're going to see a number of them being successful. And their pathways to success are actually, it's a lot easier for them to succeed as a company than it is for a vehicle company to succeed. There's only going to be a few companies out of this EV rush that we're having right now that even survive. Most of them are just going to go out of business. When the fintechs come out, though, this is not really a question of winner take all. Where people keep asking me, how do they compare to this app, or how do they compare to this app? So the market is so fractured when it comes to banking and when it comes to financial transactions. There's room for lots of players in there. It's going to be a winner take the most type of situation, just like they said in that call deck. So yeah, I'm very optimistic on fintech investing over the next decade. Jonathan mentions the same thing. If you guys don't know this, Jonathan's actually a member of my Patreon group. And he has a lot of interesting things to say about distributed finance and about the underbanked and the unbanked, and how they're a potential gold mine. And he's mentioned that before on a Zoom meeting that we did through my Patreon group with just the members of the Patreon group. We call them the Brew Club, because I usually have a beer or two while we're doing the Zoom meeting. Anyway, so look, there's plenty of opportunities in fintech that are coming up, and there's a lot of them that I don't know about that I'll probably learn about from you guys, from commenting on my channel or asking me to do a video on them. So a couple of ones. So I use Venmo, which is owned by PayPal. I have, and of course, I own some of PayPal too. I use Zelle because that's what some of the people that I work with insist that I use. And I use Sofi, and I actually use the Cash App too. So I use all of those at this point for one thing or another. I'm trying to move everything to Sofi though at some point. And as soon as they, get their banking charter finished and they're actually like a real bank, I think I'm going to be able to move pretty much everything except my business accounts to Sofi. And that's probably what's going to happen. Let me see. Top Trader says Matterport GHVI has revenues and 85 million worth a look. I will take that. I will keep that in mind. So I'm always looking for companies. So right now we haven't really seen the shakeout when it comes to SPACs. In terms of, we just haven't had enough time since the beginning of this SPAC rush, middle of 2020 until now. We haven't had enough time to see those shake out and see some of those companies start to fail. But we've seen now 2-3 quarters of revenues from some of these guys, and seen how their revenues really, a lot of them are growing at this point. Some of them aren't growing. We're going to see a shakeout. It's going to look a lot better in terms of fintech SPACs. Like I said, the Sofi's plan with the $2.5 billion or so that they raised by going public is to go out and acquire companies that allow them to expand the functionality of their app. And what they're probably looking at, and this is the sense that I'm getting, they're probably looking at expanding the capabilities of their trading app, which is actually sort of a weakness right now. You can do a lot of things with Sofi's app that I had no idea that you can do. Like, I was very curious about the financial planning and estate planning services that they offer. So I started looking into those. It's actually pretty interesting. And so I think that their plan to go out and acquire companies to add functionality to their app, just like they did with purchasing Galileo Financial Services. Not only that, they're going to use Galileo Financial Services. I don't know if you guys know what Galileo Financial Services is, but Galileo Financial Services basically creates APIs, or application programming interfaces. So software developers at other fintech companies, they don't have to reinvent the wheel every time they want to do something with the banking sector or with the financial sector. All they do is they reuse the API from Galileo, and they're connected to that world of finance and banking, right? So they're the backbone of fintech, right? So they're sort of the fintech for fintechs. So in a lot of ways, how we talk about how there's going to be some sort of open source skateboard model of EV that all EVs are going to be based on in the future. This is kind of the same case with Galileo Financial Services. There's going to be 4 or 5 ways, just like there is in the financial industry right now. There's a couple of really big clearinghouses, like LPL and like National Financial, where all of your trades, when you trade stocks, you're cleared through those. And there's a couple of smaller players like Apex and all that, which, by the way, Apex Clearing is planning to go. This may be another a good thing to look at for you guys. Apex Financial is planning to go public via SPAC this year as well. They're another backbone type of industry. Like, this is a way of betting on fintech by betting on the sort of backbone of the industry here, which is clearing trades. So that's another way. And they have an idea of not having the sort of the trade date plus 3 settlement. They want instant settlement of transactions. They have a proposal to do this. They have to get wider adoption throughout the entire industry. But this should cut the time down that it takes to have cash and trade settle in your account. And I think it's actually pretty impressive. I think it's a great idea. The problem is you have to get the entire industry to buy into it. So Sofi actually used to own about 16% of Apex. I think probably because Apex planned to go public also, pretty much right around the same time that SoFi did. That SoFi was required under regulations to reduce their stake in Apex. So that's reduced down to about 1%. Still, a 1% investment in a company that could be one day worth, $100 billion or something like that, could end up being a pretty lucrative investment and impactful investment in the company. So is SoFi better than WEBULL? Rick Neumann asks. So the question is not whether SoFi is better than WEBULL. WEBULL only does one thing, and that's trading. SoFi does a lot more than that. You have loan services through there, financial planning services through there. You can get mortgages, refinance your personal loans, refinance your student loans. You can trade stocks on there. You can trade crypto. I'd say that WEBULL's trading app is pretty basic, but so is SoFi's. I really don't think they have functionality that's absolutely fantastic. But yeah, so I think that in terms of some of the things that SoFi is looking to do is to add fractional shares, which WEBULL doesn't do that right now. No, WEBULL's looking to do that too, to add fractional share technology. I like WEBULL's app. I use WEBULL's app to do the the Fighting Words Financial Portfolio Manager Club. And the only reason I chose that is because I'd never used WEBULL before, so I wanted to use that. So I put $20,000 in that account. I let people from my Patreon manage the funds in there, which, by the way, I'm going to do an update on that pretty soon, but we're actually up for the year in terms of management. Part of that is because we've been investing slowly and a lot of it's still in cash. But at this point, I know the guys who do this are actually going to hate me right now for saying this. We're actually beating out Cathie Wood. And we're beating the NASDAQ. We're beating all of them. And a large part is because we haven't invested, but they've made some pretty savvy investments that are not in any of the ARK Invest portfolios. And that was one of the things I asked them to do, is to invest in things that aren't in the ARK Invest portfolios. And so that portfolio manager project is actually working out fairly well. SoFi is one of the things that's in that portfolio, or at least IPOE is. Let me see here. Doug B says, I'm surprised nobody has tried to pull all the financial pieces together before. I would like to see SoFi do a robust spend tracking and retirement plan package, similar personal capital. They already have that. So they have SoFi Cash, and they have, I just can't remember all of the names of the different sub apps they have within their app. They actually have all of that, a way to track your spending, a way to create a retirement planning package. They have an estate planning package, which, like I said, I haven't gotten into that yet. I was like stunned that they actually had it. And they even have this odd thing that they're getting into right now, which is tracking employee benefits. They have something called SoFi at Work. So they're really trying to turn SoFi into a one-stop shop, right? Where you can do everything through your phone. Everything financial, you can do it through your phone. So I'm actually pretty impressed by what they've done so far. Like I liked the company before I did the video, and I like them from the time they acquired Galileo Financial Technologies. I really started looking into them. But when I did all of the research to do the video, that's when I realized just how much they're trying to do. In the last 24 months, they've added so much functionality to their app that it's absolutely incredible. So I'm really looking forward to see. They're by the end of the year, they're projecting that they're going to be profitable. That's a really bold projection for a company that's going to go public at the end of Q1. But when you look at, and the weird thing is those projections of profitability don't even include what they could be making from chartered banking operations. So I think that's really impressive. But yeah, so am I nervous about the SLR expiration? Are you talking about the expiration of the lockup period? Is that what you're talking about, Fresh Aquariums? Let me see here. VJ says, hi, Jason. Thank you for all your videos. I watch all your videos. Thank you very much for watching all of my videos. I really appreciate that. And like I've said before on other live casts, like the easiest way that you can help out any of your favorite YouTubers is to simply watch the ads, right? Sit through 30 seconds, 45 seconds of an ad, and then that actually, the YouTuber gets paid a little bit more when you do that. That's one of the easiest ways that doesn't cost you anything, but 30 seconds to a minute of your time, you can help out your users. So, Doug, where's the link to join the Patreon? Let me see. Yeah. See, thank you. Unbiased opinions. Look, I try to have unbiased opinions on stocks, and when I look at a stock, I try to always let you guys know Just like I forget to tell you guys to like and subscribe, or like my videos and subscribe to my channel, or I forget to pump my Patreon or talk about my WEBULL link and all that stuff. Just like I forget to do all of that stuff too. Sometimes I forget to tell you guys when I have I own a stock or something like that. If you guys want to know if I own something, just ask. I'll tell you. I don't have a problem telling you. So even when I do a video, particularly on one that I own, I try to tell you guys that I own the stock. What I'm not doing anymore is trade. I'm not trading either 5 days before or 5 days after I do a video on a stock. I'm not going to make any trades on that. It's a sort of self-imposed rule. I worked that out with the company that I'm registered as a financial advisor for. And so in that way, if I want to make exceptions, I have to request exceptions to do that. But I'm not going to do that anymore. I don't. Not that I'm saying that my 15,000 subscribers could affect the the price of any stock or something like that. I just don't want to have any sort of appearance of impropriety. So I'm not going to be doing. I'm not going to be buying or selling a stock anytime I'm doing a video on it. Oh, supplementary leverage ratio. Okay, the exemption expires on March 31st, which will trigger a sell-off in the bond market, a rise in yield, and probably a flow from equities. That's what you meant by that. Okay, so I'm not. I'm not really concerned by that. The problem with the bond market right now is that everyone is so incredibly bearish about the bond market. I think a lot of that has already been baked into it. Meaning, the people doing the majority of fixed income trading are not the general public, not people that would be concerned about this, and not people that wouldn't have planned for this months out, like quarters out. This is something that I used to work in fixed income trading, or had a huge book of fixed income business maybe 10, 15 years ago, back when I did a lot of business trading, commercial paper, and trading short-term bonds. I got very familiar with fixed income trading at that point. But the vast majority of the public doesn't do any individual fixed income trading. Like, you may own a bond fund. A couple of people that have quite a bit more money might own a few individual issues of municipal bonds, but they're not going out there for the most part and buying 10-year treasuries. They're not buying 30-year treasuries. They're doing that through a bond fund, and it's these large bond fund managers that are doing all of this business. And look, this is something that they thought of a long time ago. This is something they priced in, and that sort of thing. So Anuj Gupta says, what do you think about EV cars from GM and Ford? So let's be fair here about EV cars from GM and Ford. Ford may be in a bit of trouble just because they're buried in so much debt. GM's a little bit different of a story, though. They have a bit more flexibility financially. They can go to capital markets and raise money more easily and cheaply than Ford can. Ford at this point, for all of their impressive work in avoiding going bankrupt in 2008, 2009, that actually kind of put them behind the curve now, 12 years down the road. They have so much debt and their stock price is so low that they can't really hit up capital markets to raise money out of thin air without paying a lot of interest on it, without it being very expensive for them to do. I think GM's in a better place to profit from this. I think they have a fair plan to do so. And let's remember, they have all of this industrial capacity. They have all this manufacturing expertise. They know how to manufacture cars. They know how to do it, they know how to create margins, create profits, and do that. And they are a real threat to Tesla in a lot of ways. Ford is no less so. But here's one thing to consider. For the last 40 years, the best-selling car in America has been the Ford F-150. The best-selling vehicle in America has been the Ford F-150. I'm actually stunned that someone didn't build a pickup truck, an electric pickup truck before now. Like, I'm stunned that Rivian has not come out with a product yet. I'm stunned that Lordstown doesn't have a product yet. I'm stunned that it took so long for Tesla to build a truck. It's just stunning to me that somebody looked at the best-selling car in America and said that we can't peel off a portion of people that are in that market segment that just want something different and useful. So I'm actually stunned that never happened. Let me see here. And so that's one of the things that actually blows me away about that. So I think that Rivian owning having a portion of Rivian being owned by Ford is actually really beneficial for Ford. I think that's going to turn out to be pretty successful for them. I don't know what their arrangements are in terms of technology sharing or anything like that, but Rivian's vehicle basically looks like a Ford F-150, and I think that like I want to buy a Cybertruck when it comes out, right? I have uses for a Cybertruck. Like I want to build a really large boat in my backyard. I'm going to need something to tow it with, and so I am considering buying a Cybertruck. However, I know a lot of people who drive trucks, and they're not going to drive a Cybertruck simply because of the way it looks, because it doesn't look like a truck. Rivian's truck essentially has all of the same capabilities that the Cybertruck does, not the same software capability, but the same towing capacity, the same acceleration capacity, all the stuff that make it an electric truck. But it looks like a truck, and in that way, I think that they've already got a window into a market which may be a little bit better than people think out there. So, so I think that Rivian could do really well, and by that measure, because Ford has some sort of arrangement with them, Ford might do a little bit better. But I think, I think that people are waking up. So if you looked at the news today, and like I said, your algorithm may feed you different news than I get. But I get a lot of negative Tesla news fed to me through financial media. There is a definite bias against Tesla and in favor of incumbent auto producers, right? And that bias is related to advertising dollars. Like these guys spend billions of dollars a year advertising their vehicles, and Tesla doesn't spend a dime advertising, right? So there's no financial interest in a news organization publishing things that are positive about Tesla because there's no advertising dollars that are on there. Like there's not a one-to-one correlation there. That's not the reason every article is published, but it does create a little bit of a bias there. That's the reason why you see, Nikola getting all of this positive press, even after all of the stuff came out. Nikola got all kinds of positive press from financial news organizations and even from mainstream media. And in large part, it had to do with how many GM executives work, or former GM executives and former auto executives in general work for Nikola, right? They have these relationships with the media, when in reality, there's no reason to be positive about that company. I think there's more reason to be positive about it now that Trevor Milton is out of the picture. But so the Martin Cosino says, actually, Martin, are you actually from France? I don't know. You say you sound the best advisor out there, honest, sincere, solid analysis, no pumping and no chasing stocks that have already 10x. Thank you very much. Like I said, I don't see the need to pump or mention 10x or double your money or get rich overnight. None of those things are really frequent occurrences in the market. If you really want to read the most fascinating piece of literature that's available on stocks, like statistical analysis, and this is really dry reading, guys, but it's called "Do Treasuries Outperform Stocks?" And it was written by a Hendrik Bessenbender, who's a professor at Arizona State University, professor of finance. And yes, it has a ridiculous title, but if you can get past the ridiculous title and read it, you're going to understand that, and it's not about treasuries outperforming stock, but you're going to understand why stock picking is very difficult, why hype doesn't help you, and why emotions just get in the way of actually being a good investor. So Nathan W. says, thanks for your time. We're married, filing jointly. Only one spouse working in the high income bracket, already maxed the 401k. Is it possible to have a backdoor IRA for each of us? I assume that you mean a backdoor Roth IRA or a backdoor IRA. A backdoor Roth IRA, yes, it is possible to do that. So as long as your spouse is not eligible for a retirement plan through her employer, you're always able to make a contribution to your spouse on her behalf. Now, if you're outside of the income limits to get a deduction on your IRA, you can still make a non-deductible contribution to an IRA and then convert it to Roth. You can leave it in the IRA if you want to, but if you already paid taxes on it because it's non-deductible, you might as well just convert it to Roth. That's the backdoor Roth IRA or Roth IRA. That loophole has been around since 2006. I have exploited it every year that I can. All of my clients exploit it every year that they can. This is something that's that you should be exploiting. And I don't know, folks, if you're a younger investor and you're watching my channel and you're not using a Roth IRA, I would highly encourage you to watch a couple of my videos that I've done on the Roth IRA. the one that I did recently, like 5 advantages of the Roth IRA. You should really look at that. The tax bracket. So there's basically one tax bracket that captures most of America. It used to be the 20% or 20% tax bracket. Now I think it's the 22%. Yes, it's 22% tax bracket or something like that. But basically, it covers income, and it's always in the same range of income. For a married couple, it covers incomes between $70,000 or so and $140,000. Now that changes a little bit over time, but that's where most people who are working, they're going to be in that tax bracket if they're a married couple. When they retire, they're actually going to be in that same tax bracket, right? So the problem is you're only in that same tax bracket when you first retire until you hit required minimum distribution stage. And then at required minimum distribution stage, past age 72, you're forced to take out a certain percentage of your money from a retirement account every year. So, and at that point, you can't actually control how much income you have. You have to take out more and more and more every year. And it pushes you up into a higher tax bracket. So the Roth IRA makes a lot of sense for a lot of investors at any income level, depending on how you want to look at things. I max out my Roth IRA every year, and I have through my company, I have my own retirement plan, which is tax deferred. But I max out my year one way or another. You guys should do it as well. Ça c'est parce que je parle français, Martin. There you go. Anyway, Nathan, I hope that answered your questions. Let me see. And Shoeless Joe says, and is growing a lot faster. So it does speak volumes that Tesla doesn't need to advertise and is growing a lot faster. But let's be honest here. GM produced 7.5 million vehicles last year, and Tesla produced 500,000. GM can basically afford to sacrifice some of their industrial capacity on the ICE side in order to build out their vehicle line for electric vehicles. And they can afford to do that for quite some time because they're in pretty good condition now, better than they were before. But yeah, so are they a real threat? But I'll tell you who I think the real threat is to Tesla's dominance. I think that's actually VW at this point. And this is not something that I wanted to believe, because I really don't like VW. Ever since they had that big scandal here so ever since they had this big scandal with Dieselgate here in the US, Jonathan actually just says, I still think WJAC is well positioned in EV wars. Tesla does a cool thing, but it may be boiled down to the ability to scale. Jonathan, that's actually where I'm going with this. Part of Tesla's huge plan for worldwide dominance is to grab a significant portion of market share in China, right? And they're doing really, really well, and they're outselling every EV maker out there right now in China. But when you look at who's dominating sales in China in terms of market share, nobody does. Nobody has a large enough market share that is all that significant. But the company that does have the largest market share in China is VW. Between VW and WJAC, they'd have about 14% of the market share of China. Right, which means that at this point, they're already producing about 1.8 million vehicles a year between electric vehicles and ICE vehicles, and that's the best-selling vehicles in China. So how did they become the best-selling vehicles in China? It actually isn't all their cheaper models; it's some of their higher-end offerings, right? So they kind of got in through the middle class and the upper middle class there, and they're a well-established brand. So and that's actually the same customers that NIO is going after. That's the same customers that that Tesla is going after. And the other thing is VW now owns a controlling stake in JAC itself. They have the joint venture JAC VW joint venture, but in JAC itself, VW now owns a controlling stake too. So they own quite a bit of the industrial capacity for creating EVs in China, including all of NIO's industrial capacities. VW has a hand in that. So I can actually see greater cooperation between VW and NIO at some point. And I think that's kind of the real threat to Tesla at this point is a combination of JAC, NIO, VW, NIO having their own factory share pretty soon, which that may have been a large impetus in their decision to go out and build this new industrial EV park, which they got a lot of government money to do that. Yeah. So Doug B says, it seems strange that VW is bigger than BYD, which Buffett has backed for a decade. So I'm pretty sure that Buffett bought his shares in BYD for under $1 when they were about $8 a share. But not only that, VW is a company that I think goes all the way back to the early 1920s. So they've been around for quite some time. They survived World War II. They survived a couple of other events. VW is a really large and global producer of automobiles. And yeah, I'm not surprised by that at all. They've had far greater access to capital markets than, because China hasn't had, so raising money, going public on Chinese markets has not been as lucrative as raising money in the past. Has not been as lucrative, of course, as going public by going on the New York Stock Exchange or the NASDAQ or something like that. This is one of the reasons all of these Chinese companies want to go public on our exchanges. So Germany has their own quite healthy, stock exchange. And VW has had ADRs here in the United States for I don't know how long, but it's been a very, very long time. So they're trading on our exchanges as well. I'm not surprised. That is possibly not the best way to look at that, Doug. What stocks did you buy the dip days of the last few weeks? I bought some Tesla. I did buy some Tesla. I bought some more IPOE. I bought a bunch, like at $13 a share, which is great because my position, I kept buying that over time, and I bought some as high as like $24 per share, or $23 per share or something. So I lost a lot of money on those shares so far. Not that I'm all that worried about that. Like what I buy, I'm going to hold for probably 5 to 10 years, and no shorter period than that. Yeah, and I bought a little bit more of Xpeng, and then I had to stop buying that because I just have too much in the way of EVs, guys. I'm probably not going to be buying any more. If I'm not buying Tesla, I'm probably not buying any more EV shares. But I'm actually spreading my funds out to a bunch more fintechs. Like I bought a little bit more Square, and I bought some more of ARK-F too, just because I wanted to spread things out a little bit. So if you guys, so there's another ETF out there that you guys might want to check out that specializes in companies that like innovative companies and innovative technologies, and it's traded under Moon, MOON, which I know that, of course, to the moon, all this stuff. Let's go on the Reddit Wall Street Bets things, but it's actually performing quite well. It's a relatively new ETF, but when I looked at the holdings inside of there, they do have quite a bit of holdings that are not in any of the ARK funds, right? So this is a second way, and I haven't. I mean, I own some of their the ETF just because I have to admit I bought it on a whim. Not gonna lie. Didn't do a ton of research on it. I looked at the holdings in it, but I bought 100 shares of it just to keep that on my radar here. But when I looked at the holdings inside of it, they have a lot of smaller, more speculative plays than ARK's funds. But also, I just want to have something that's different than what ARK is doing, but still focused on innovative technology. And I do that a lot, where it doesn't matter what everyone else is doing. It doesn't matter what everyone else thinks is popular. A lot of times I'm just going to do something different because that's what I want to do. But yeah, so Paulo, that's some of the stocks that I bought. But if you guys haven't checked out Moon, the ETF that trades under MOON, try that out. So Fresh Aquarium says, I think that Tesla should be more worried about Xpeng than NIO. Honestly, I agree with that. But I agree with that from my perspective, which may be a little bit biased. Like I said, I'm more impressed by their ability to raise capital, how they managed access to capital markets, meaning their timing of when they raised money, how they managed their cash flow, the speed at which they're building out factories, the speed at which they're investing in other companies that are going to further their aim of becoming a technology leader, a software leader in making vehicles. So I think they figured out that the actual making vehicles part is easy. It's making all the features for the vehicles that differentiate you from all of your competition. That's going to be the hard part, and that's where they're doing all of their R&D. I think they're just going to continue to build out industrial capacity and sell more cars over time. The market that they have chosen to operate in, which is that mid-level, below that market that's in terms of income is below where Tesla is and it's below where NIO is. It's a broader market. Steve Hansen says, is this really a live stream? Yes. I don't know how much of a delay there is though, Steve. So yes, but it's really a live stream. If you have any questions, go right ahead. So aren't capped at like 7K per year into a 401k. If you exceed that amount, I thought you couldn't do a Roth IRA. No, that's not true. So if you have a retirement plan at work, like a 401k or 403b, you can contribute up to the maximum amount, which is, it depends on your age, but it's either $18,000 a year if you're under 50, and there's a catch up if you're over 50. I don't remember exact numbers or exact dates, but it's like $5,000 or $6,000 more. You can make a full contribution to your 401k or 403b at work, get your matching contribution up to the 415I limits, I think, are like, I think total between that and profit sharing, you could put in like 54,000 a year or something. And you can still make a contribution to a Roth IRA, but you may have to do a non-deductible contribution to an IRA first and then convert it to Roth using what's called the backdoor Roth option. So anyway, Steve, I hope that answered your question. So your limits for your 401k and your limits for your IRA, they are separate from each other. Like there are income limitations. If you have high income and access to a retirement plan at work, it may be that your contribution to an IRA, a regular traditional IRA, may not be deductible, but it doesn't mean you can't make a contribution. So if you have no income or very little income, you can make a contribution to an IRA or a Roth IRA up to the limit of your income. So Steve Hansen says mostly trolling because I didn't see your question there? All right, sorry about that. So Shenez Alidina says, does Google have good growth? So yeah, they do have good growth prospects. And a lot of what I don't understand about them right now is, and I think a lot of people don't understand where they are right now, is how far along they are in taking their artificial intelligence advantages and packaging that up into products that work for other parts of their business. So yeah. So I do think that Google still has a lot of growth out there. Google is something though that I don't own outside of an ETF. I don't think that you're going to buy Google and in the end you're going to get a better result than simply owning. But basically, if it's a large cap stock that trades on the S&P 500, I probably don't own it as an individual holding unless I bought it before it ever got on the S&P 500. Largely because you aren't going to have the ability to sort of beat out the market for a lot of those stocks where all the information about the stock is basically publicly known. The market prices all of those stocks efficiently. And I just don't think you're going to beat the index. And that's actually borne out by decades of research. Your only chance of really getting superior returns is having a pretty healthy degree of luck, understanding what you're investing in, and being willing to take losses. Because that's kind of thing when you invest in individual stocks, guys. And I know I cover individual stocks a lot on my channel here, largely because it's fun and because I find these companies interesting and I love the technologies they're invested in. But you have to realize you're going to have just as many failures as you have successes when it comes to investing in stocks. We've had this long period now where it's been almost impossible to lose money in stocks. And the thing is, it's not just always a great market where that really tests investors. It's not even a bad market that tests investors. Sometimes the stock market goes through long flat periods, and that's when you really find out if you're good at making decisions with investing. There's a lot of ways to lose money in a flat market. And if we have a high degree of inflation, I'm not saying that I believe we're going to have a high degree of inflation. I actually don't. But let's say we did have a high degree of inflation like the 1970s. The market was essentially flat in that time period. The Dow Jones hit 1,000 in 1966, hit 1,000 again in 1982. It was flat over that 16-year period. And yet there were tons of ways to lose money in that time period. That's when a lot of investors were really tested as far as whether or not they had the discipline to make money over a long period of time. And there were a lot of ways to make money over a long period of time, mostly with buy and hold type of strategies. But yeah, so it's not just a down market that really tests investors. A lot of people get discouraged because they don't see their investments moving fast enough, and they make more and more frequent trades. And remember, guys, every time you make a trade, for every buyer and seller in that transaction, there's a winner and there's a loser. There's someone who's buying it at the right time. There's somebody who's selling it at the right time. And you can't assume that the other person on the other end of that transaction knows any more or any less than you do, or knows any less than you do, right? We're all just folks on the internet here, who have access to the internet. None of us have access to special knowledge or anything like that. So Doug B says, yesterday I sold the last of my hydrogen holdings. The next morning I saw the headlines about Plug. It's nice to get lucky once in a while. Yes, Doug, it's nice to get lucky once in a while. So I don't have Plug Power, and I think I covered that in the video. And I said I thought they were an overrated stock back when they were $28 a share. They're at $34, $36 a share right now. I still think they're an overrated stock. Largely, it has to do with the people they put in management. They never put people with like real engineering expertise in management. It's always somebody who comes from the auto industry. It's somebody who comes from, like who ran a chemical plant before, or it's somebody with an MBA, right? It's never somebody that really understands the products that they're delivering, the possible ways to exploit those. I don't know if people even realize right now that the primary way that they make money right now is by selling forklifts. They have a couple of large clients who buy their forklifts. So yes, their hydrogen fuel cell forklifts are superior to the battery electric forklifts that were powered by lead acid batteries. The problem is they're not really better in terms of energy use and output than modern lithium ion batteries or anything like that. And if you look at their website and you look at how they compare their hydrogen fuel cell forklift to the battery electric forklift, they're comparing it to a lead acid battery powered forklift, right? And except I think there's a couple of large companies that are keeping them in business by buying their products. Like Amazon has a bunch of hydrogen powered forklifts, but I really think they're doing that for optics and not because they really believe in a hydrogen future. And we've covered this before on my channel, but I love the idea of a hydrogen future. I don't have anything against hydrogen fuel cell technology. I do have something against Plug Power, though. I've tried to invest in them over the years. They've been consistently disappointed by their management. They've consistently made missteps in this accounting error. Like, I don't think is anything nefarious. They're going to restate earnings. It's probably not going to affect that earnings that much. But their earnings were already a disappointment, guys. They already had these widening losses. So anyway, yeah, I'm not a huge fan of Plug Power. Like I said, not because I have anything against hydrogen. Yes. So I do think here, Ballard Power is doing a lot to develop solutions in hydrogen fuel cell technology for maritime shipping. I do think that there's a window for success for hydrogen in maritime shipping. You know where a ship is going to refuel. You know that's where, because they refuel at ports, right? You know that you can create those refueling facilities there. You can create those hydrogen separators in that location instead of having to create them all over the country and invest hundreds of billions of dollars in creating, hundreds of thousands of fueling stations to replace all the gas fueling stations or gasoline fueling stations. With ships, is going to be a different story. And you're replacing diesel at this point, and hydrogen is not close to being the same price as diesel right now. But a combination battery electric hydrogen fuel cell powered ship, there's already a few of them being made. Japan and Norway have invested in these technologies. I know that they have ships that are already out there. And so I am pretty excited about some of those technologies, but they are far from being mature at this point. I want to see how that works out. Let me see. I feel bad for the post-go-go era investors. Imagine losing 60% inflation included over a decade. I'm not sure what you mean by go-go era. So you have to, yeah. Steve Hansen says, I'm taking a bath in Plug and F-Cell. I would understand that. I understand that you are, Steve. And like I said before, I think that these technologies have not found out where they're going to be applied at this point. And I think that the vision that most investors have about how they're going to be applied is far too broad. I think their applications are going to be pretty narrow. I think there's a window for application in the extreme long-haul trucking. I think there's a window for applications in maritime shipping and a few other things. So Nathan W. says, what was the price point when you bought Tesla the last time? So I was trying to buy it in a couple of different accounts. I got a single share at like 540, and then I got a call from work. By the time I got back to my accounts, it was already back up to like 590, right? So I bought most of it right around 590. that I bought recently. But no, I literally bought one single share in my HSA account for $540, and the rest of it around 590. What do you think about banks and the mortgage company? One more time, we'll go away and shoot. Anuj, that's actually a good question. So the banks learned their lesson from the foreclosure crisis in 2008 and 2009. And what they learned is they didn't make any money by foreclosing on all of those properties. They ended up losing money by foreclosing on all of those properties. So in a lot of cases, they're probably going to work out loan extensions for people that haven't made payments on their loans. They're going to, if you haven't made payments for a year, they're going to add a year onto your mortgage and charge you a penalty, right? More triumph on evictions too. Like, I don't think they're interested in evicting people like they were before, because most of the properties they got, they didn't have any way to maintain those properties. They fell in. You don't realize how quickly a house that is unoccupied falls into disrepair. I owned a house in San Antonio that I moved away from San Antonio, moved here to San Diego. It wasn't a great house to begin with. I think I bought it for like $45,000. I was planning to fix it up and sell it, but I got a contract out here in San Diego. I moved. It was a year before I could get back to San Antonio and sell it, right? And in that time period, it wasn't like squatters moved in. It wasn't like a family of raccoons moved in, but the house just fell apart in a year. And small things that I would have repaired if I was there just became a huge disaster. Now imagine this, something on the scale of 3 million evictions like we had. And I don't know how many evictions were. I think I was reading somewhere that were 3 million homes that were empty, extra homes that were empty by 2009. The banks that took over these homes had no way to take care of these homes. They didn't have the people in place or the expertise in place to manage these. They didn't turn them into rentals, and they didn't have the ability to maintain them. And these places just fell into pieces. Now, a lot of investors were able to pick them up for pennies on the dollar if you were lucky enough to have money at the time period, and they were able to make money. But the banks, for the most part, didn't make money by foreclosing. And I think that this time around, they'll probably be a lot more intelligent about it. They'll probably just work out a way to extend loans. Let me see here. So Jonathan says, Doug says, James Bond says, I'm wondering if you think that the Fed will keep the interest rate the same until 2023 as J-Powell promised, or they might raise much earlier, even before the end of 2021. I think that they'll probably end up raising interest rates before 2023 happens. I think that we're probably going to see a pretty extreme heating of the economy here as the economy opens back up. Like, even in places where the economy is open, it's still not completely open. People haven't gotten over their fear. And the one thing is somebody here was kind of calling BS when I was talking about like pent up demand. They're saying there's people are going to save their money because they're afraid. This person probably doesn't work in the financial industry. If you did, they would realize that Americans don't save money for the most part. Like, if you're watching my channel and you have money in the stock market, that actually makes you pretty special, right? Back when I worked as a financial advisor for a local bank here, a regional bank here in California, I went into a meeting and we talked about who our target customers were, and our target customers were people that had $100,000 more and had a certain level of income and all this, and that turned out to be 4% of the population of bank customers. That was it. That was just 4%. Those are the people who could afford to make after-tax investments. So we wanted people who had already made their investments to the retirement plans, and now they were looking to make investments outside of their retirement plans. Americans just don't save money. We're not savers in terms and culturally like a lot of other cultures are. Like I have family that lives in Japan. Everybody in Japan's a saver. Everyone there has, not everyone, but of course, but many people there are in much better personal financial condition than they are here in the U.S. If you look at personal net worth, it's a lot higher in Japan than it is in the U.S. because they have far less in the way of debt and far more in the way of savings. I do think that the economy is probably going to get overheated, because as soon as many people have more money in their pocket, the first thing they're going to do is go out and spend it. They're not going to save it. They're going to spend it on everything under the sun. And so I think that there's going to be quite a bit of overheating the economy, and I think that they'll raise interest rates before 2023, like they're promising right now. And I don't think Powell promised. He said that he was saying that they probably won't raise until the end of 2023. Raising interest rates is not a terrible thing, guys. It really isn't. It has temporary impact on the stock market, but only some stocks. Remember, financials, which we're talking a lot about today, fintech, financials do very, very well in a rising interest rate environment. Also, in a rising interest rate environment, judicious fixed income traders will do very, very well in that time period too. So Gary Tesler says, I am holding ICLN ETF, which is heavily weighted in plug and Enphase. Unfortunately, Enphase, I'm not sure why their stock has skyrocketed as much as it has. It's another company that I like. I think that lots of people are going to use their power management technology. I'm not sure why it's so it's high as it. So Steve Hansen says, do you use trailing stops to limit losses? I do not. I'm not interested in short-term trades. I'm in a higher tax bracket. I don't like taxable events. I can't. For a couple of different reasons. Number one, I have to report all of the trades that I do to a compliance department anyway. So I'd like to do as few trades as possible. But the other thing is I'm a long-term investor. Frequent investors lose money over time. This is an established fact. Way back in the dark ages in the 1990s, investors used to believe in something, used to believe in active management. They believed that you could find good active managers of investments who were really good at trading, who would provide alpha over an index, right? So basically what alpha, I'm going to give you the short version of what alpha means. Alpha means basically for every given unit of risk that you're taking, you're achieving an additional bit of return, right? So let's say if your alpha is 3%, it means that you're taking the same amount of risk as the index is, but you are getting 3% more in the way of return. Let's say if it's the S&P 500, the S&P 500 returns 10% a year, and you are getting 13% a year, but you're taking the same amount of risk, right, as the S&P 500 is. I mean, you're getting 30% more return for the same amount of risk as the S&P 500. You have alpha, right? So what was determined by academics after looking at 70, 80, 100 years of trading data surrounding the stock market, what they found out is that alpha was very elusive to define to begin with. But number two, what they found out is that almost no manager outperforms their given index over time. And if they do, they're not able to repeat that performance. And if they can't repeat the performance, there were always these excuses. The excuse was, they drifted away from their core principle, right? They decide they changed strategies midway. They're no longer a value investor, or they're no longer investing based on growth. They changed these strategies. The reality was they never really could outperform their index. It's not possible to outsmart the market without a really heavy degree of luck, based on the way people were doing investments back then. And it turns out that most of your return, in fact, there was a guy named Harry Markowitz who discovered this in 1952 or something like that 91% of the return of your portfolio is based on your asset allocation, and things like market timing and things like stock selection actually don't matter that much. And this is not something that people want to hear. And this is something that I could tell people this all day long, every day, and they won't believe me. But the data, the research is out there. None of it's new. It's all repeatable. And people keep redoing this research every couple of years and keep coming to the same conclusion. And this is one of the reasons why most of my portfolio is actually in index ETFs or just broadly based ETFs. Like I tend to hold, because I don't like the fact that the S&P 500 right now is dominated by 5 companies, right? And there's so much in those 5 companies. For a lot of my large cap holdings, what I hold is a dividend growth fund instead. Which like DGROW or NOBL Noble. I hold a couple of those instead of holding an S&P 500 fund, because I just don't want to have any more Google. I don't want to have any more Microsoft, and I don't want to have any more Amazon, right? So that's what I hold instead of having an S&P 500 fund, just because I think there's an inherent risk in having an index that's dominated by such a few stocks. But yeah, those are the dark ages. And now, if you're paying attention, Jack Bogle was right that for the most part, you can't outperform the market without just being lucky, right? Let me see. And yeah, so Doug and Steve, we did talk about a little bit how Plugs were having to restate 2018, 2019 earnings, and they get clobbered for that. But they're going to have to restate some of their 2020 earnings as well. Let me see here. I'm trying to. The 1960s go-go era. Oh, the 1960s go-go era. That's what was dominated by growth, which was torn apart by inflation and the oil shock. Very interesting, Jonathan. I was doing some research on the stagflation era a few months ago, and I was actually surprised that that stagflation was not really blamed on anything other than government attempts to control prices. Meaning, because of the oil shock, there were price controls that were placed on a number of different commodities here in the U.S., and they blame inflation on that. I'm not sure that I follow the logic behind that, but Investopedia and a couple of academic sources actually blame it on that. I'm going to say the stagflation was complex. It wasn't just one thing. It was a lot of things. So Shula's Joe says lots of pent-up demand. I reckon frustrated people indoors, not commuting, not eating out, and lots of disposable income for those who are still working. I think that's true to a degree. I think that everything that people wanted to buy online, they pretty much bought in 2020. And now I think that where people are going to spend their money when things really open up after we've all got our vaccines is in experiential things. They're going to go travel. They're going to go to the movies. They're going to go on cruises. They're going to jump on planes and head to Europe. They're going to do everything that they couldn't do. Like they bought, if you had the money to buy things, you probably bought things to fill that hole in you this year or in 2020, that hole that you felt from staying at home all the time. Like I actually finished building a boat in my backyard. I actually just got the paperwork today to register the home built boat, and I'll be fishing in it this summer. And but like all of the things I'm done, like the thing I want to do when all this is over is I want to do stuff. I want to experience things. I don't want to own any more crap. So, hello, Jason. What did you do with Lee stock? Are you holding Lee Auto and NIO? I still hold Lee. I bought 250 shares like back after it dropped a little bit back in January. And of course, I've gotten hammered on that just like everyone else has. I'm essentially down 60% or something like that on that stock. I'm still holding it at this point. Like I said, I'm a long-term investor, and that's the one thing I'll stick by my guns on this. I think that Lee Auto has a really good strategy for, and I think they're actually going to be profitable by the end of the year. I know that sounds crazy. Like they had their surprise profit, right? But I think by the end of the year, we're going to see full year profitability from Lee. Lee's planning to start offering a full line of battery electric vehicles beginning in 2023. And I think they really timed out well the expansion of Chinese EV charging infrastructure. Meaning people can buy their car right now, buy the Li One right now without feeling a ton of anxiety about range, because they've got almost 500 miles of range between the, they got, I think it's, depending on the model that you get, you can either get 70 miles or 130 miles just on the battery. Plus you have the the generator, the gasoline generator on board, stretches that out to close to 500 miles. But guys, that's an NEDC standard. It's probably closer to 380 miles or something like that. Anyway, but that eliminates a lot of the range anxiety that folks feel about having the EVs. By the time they come out with their full EV line, they're going to be an established brand. And then all of that EV infrastructure will have been built out by everyone else who's building EV cars for them. So I think that they have, and their founder, I like their founder, man. He's a bit of an oddball. He, unlike the other guys in that entrepreneurial class, he doesn't have the same level of education that the rest of them do. He's always been known, Li Sheng has always been known as kind of an oddball in the industry. He says just blunt, honest things that a lot of people don't say in that culture. And I do think that he thinks a little bit differently. He admits his mistakes. He talks about his mistakes. He talks about what he learned from his mistakes. So in a lot of ways, I like Lee as a long-term investment. I wish, of course, that I would have bought those shares at a larger price, which means I'm planning to be underwater on those shares for at least a year, because I bought it the wrong time, guys. I should have waited. I was nervous about the market and waiting for a pullback anyway. But I should have waited until the pullback was a little bit deeper. Do you think the price has been built into the stock as an energy business? I'm hesitant to start buying Tesla as an EV company with the current price. I think to a degree that's been built in a little bit, Nathan. But let me put it to you this way. I will probably buy Tesla at least one share a month or whatever I can afford, but probably at least one share a month. I will probably keep buying Tesla for a very long time, maybe for the next decade before I stop buying Tesla. I think that their energy storage business is already a $3 billion a year business, and nobody talks about it. Right? I did a video on it, and nobody liked it. Right? Maybe it was a terrible video. I don't know, but the reality is he talks about it, he mentions it, but nobody really talks about the numbers behind the energy storage business. It's booming right now. They're doing tons of business, and right now they're building a 100 megawatt power station in Texas. Right now, which because of what happened to them with the freeze, I'm sure there's more impetus to invest in their electrical infrastructure. I think we're going to get an infrastructure bill out of this administration that's basically going to be a larger infrastructure bill than we've seen since the 1950s or 1960s. And I think that a lot of that's going to go to building out energy storage and energy management to a degree. Excuse me. Let's see. I think position size is the only stop loss you need. If you need a limit, you own too much of it. That's actually true, and that's what triggered my sale of NEO back in December. Is that NEO had grown to 13% of my overall net worth. So I worked as a contractor, not for Enron, but I worked at Enron as a contractor programmer when Enron went under. And you don't know how many guys that I talked to that were in their late 40s or early 50s. Who had 100% of their 401k invested in company stock, and they lost everything. And I remember thinking, I was young, and when you're young, you think things that are kind of cruel. And I remember thinking these guys were idiots, right? And it happened again in 2008. I knew a couple people that worked for Washington Mutual, and two ladies that worked for Washington Mutual that had over $600,000 their entire 401k in Washington Mutual stock because, hey, it may go down, but it's always come back. Well, it didn't come back. They ended up losing their entire retirement. I don't know what happened to those ladies because they wouldn't return my calls after that. But yeah, so I don't let anything get above 10% of my net worth if I can help it. I didn't want to sell any of my NEO stock, but to be honest with you, I never expected it to grow as quickly as it did. I took a giant risk thinking that, hey, I'll buy a few thousand shares here and I'll double my money and then sell. And then I just didn't sell. And because I never do short-term trading like I say I'm going to do to myself. I never do it. I'm a buy and hold investor. That's just what I do. But yeah, so I ended up buying more of that than I expected to. Like I said, I wasn't as disciplined as I would like to be. Steve Hansen says, do you really think Tesla has significant upside from here? Yes, I do. And a lot of it, like I said, has to do with their energy storage business. Their energy storage business is not just one thing either. It's highly diversified. They're going into vanadium flow batteries. They have several different types of chemistry they use for their stationary storage, their lithium batteries and stationary storage. They're investing heavily in some other battery chemistries as well. And remember, it's a whole different battery game than just making electric vehicles, meaning you don't need your highest density batteries for this case because size and weight are not the same limitations with the energy storage business, stationary energy storage business, as they are with electric vehicles. But this is a $3 billion a year business that's only growing. It's only going to grow much larger from here. Jonathan says, on one hand, I love picking stocks, but on the other hand, those 5-factor models, yeah, it's really hard. Like, I don't know if you guys have ever looked at the Boglehead's like 3-fund strategy. It's actually really hard to beat the 3-fund strategy, which is the S&P 500, a little slice of international, and a little slice of bonds. Man, over time, it's really, really hard to beat that strategy. The problem is it's so friggin' boring. Who wants to do that? Yeah. Shoeless Joe says, Lee knows how to look after their finances. Yes, they do know how to look after their finances. And like I said, all of those guys made the right decision in going back to capital markets and raising money when the stock price was high. And they will do that again. And I remember when I did a video on that and said, oh, well, this company just did a secondary offering. NEO and Xpeng will soon follow. And I got a number of comments on there, including ones where people were like basically screaming at me through the comments, oh, NEO won't do this. And then they did it a week later. I'm not a clairvoyant or anything, guys. It just makes perfect economic sense to do that. Your price spikes by 100%. you need to raise money to build factories or put hundreds of millions of dollars into R&D, then why don't you have a secondary offering? This is what Tesla did over and over and over. The amount of vehicle sales they had could never have created the company that they have today. I don't know this for a fact, but I would suspect that the value of all of the factories and equipment and land and all that they own, that's probably worth far more than the total cumulative value of all of the vehicles that they've sold up until this point. And if you think that Tesla is in no danger at all and they've made it at this point, maybe at this point that they have, but even 2 years ago, that was not true, guys. That was definitely not true. They skillfully and wisely used capital markets over and over and over, and secondary offerings, and convertible bonds is the one thing that Tesla used quite a bit to raise money, to get low interest financing that people could convert into equity rather than having to pay back the debt. NIO has done a lot of that too, convertible bonds. And they had some convertible bonds that they issued in April of 2020 that those folks were able to redeem those beginning of September, and I think this month is when the last of the lockup for those convertible bonds expires. So those people bought that with an exercise price of something like $3 per share or $3.19 a share or something like that. I don't remember the exact numbers are, but they've made a fortune, an utter fortune, by rescuing NIO. Let me see here. Do you stick with shares or do you buy anything on margin? I rarely buy things on margin. It's just, I can't remember the last time I did, actually. But for the portfolio manager club that I have set up through like WEBULL and through my Patreon, I do allow those guys to use margin. They haven't used it yet, but they can use margin if they want to. Is there a way to invest in SpaceX or Starlink yet? I was hoping they would be brought public. Yeah, so I'm not sure that there's not a way to invest in them right now. And there's been a proposal put out by a couple of like activist investors and a couple of like YouTube folks for Tesla to put together sort of a holding company that's going to hold Tesla, or not Tesla, but Elon Musk put together a holding company that's going to hold Starlink, it's going to hold SpaceX, it's going to hold Tesla, it's going to hold a couple of other companies that they own, like Boring Company and all that. Kind of like Alphabet is set up, right? And there's people that are in favor of that idea, and there's people that oppose that idea. I haven't really looked too heavily at the arguments on either side, but I would say that will probably happen at some point. And it makes sense for that to happen at some point because eventually the holding company will divest themselves of those subsidiary companies and they'll end up going public on their own. Like if you guys don't know, I did a video on Vimeo, and they're owned by a company called Interactive Technologies. Is it Interactive Technologies? It's Interactive Corp. It's Interactive Corp. That's what it is. But they're basically the anti-conglomerate company, right? They buy like companies that aren't quite at startup stage. They may be public, they may not be public, but they buy companies when they're relatively small that have a good idea that can be grown. Then they grow those companies and then they spin them off as public companies, right? So if you own Interactive Corp, you have gotten, if you own 100 shares of Interactive Corp, over the years, you've gotten like 300 or 400 shares of other companies that have done really well. And I guess the most commonly known one is Match.com, the dating service, right? So they bought the dating service, they built it up to an enterprise where it could go out on its own. And now it's like, last time I looked, it was like $140 a share or something like that. But you got 100 shares for free if you owned Interactive Corp. Well, they're doing the same thing with Vimeo. Vimeo has a business model that's probably slipping below notice for a lot of people. Like I've worked on a couple of websites who developed a video curriculum either for martial arts or for stock trading or anything. I've helped people develop websites and develop like video curriculums and put them online. And all of them are using Vimeo to serve the video, right? Because it has better access controls. They have a pretty substantial business doing that, right? So they haven't focused on advertising revenues like YouTube has. They're doing it a little bit differently, and they're serving super high quality video, and they've kind of really got in on this like business to business angle on this. So I do think that's a pretty, I think it's going to be an underground mover, meaning some of the most money that I've made on stocks are things that you don't really think about. Like I bought Hanson Natural Products, I think in either 1998 or 1999. Like I got, it's a funny story, but anyway, I bought Hanson Natural Products because I got dumped by my girlfriend at the time and I couldn't buy beer. And I ended up having a grape soda, Hanson's Natural Root Beer that was absolutely amazing. And I went out and bought, a couple thousand shares of their stock for nothing. It was like $1 per share or something. Fast forward to 2005, it's worth quite a bit of money, right? And the other one I made a lot of money on was a company called Asta Funding that collected on credit card debt. But these are companies that you probably haven't really heard about or don't think about, even though Hanson Natural Products is Monster Energy drinks right now. So you have heard of that. A lot of the growth happened before they were ever Monster, right? So Hanson was very popular. I think that Vimeo could end up being one of those stocks where it's underground. They don't get a lot of like publicity. They're just a consistent performer, and they have good financials year after year after year until at some point you look back and you made 6,000% and you were never paying attention to them. There's been a lot of stocks like that. And and I said, those are the ones where I just got lucky. Like there was no skill involved in that. I got lucky, right? Yeah. So hindsight is 2020 and FOMO is real. FOMO is very real and hindsight is definitely 2020. FOMO is the one thing that when you watch my channel, I hope you're not getting. I don't want to hype something up so much that you guys think you're going to miss out by waiting a day or two and then buy something at the wrong time, the wrong price, whatever. I don't want you guys to think that. Investing, no matter what you're doing, is a long game. If you look back over any 6-month period and you're disappointed by how much your stock portfolio has made, it actually doesn't matter how much your stock portfolio has made. Looking back over a 6-month period and feeling disappointed about it is the wrong approach to take. I take a year-over-year approach. I don't even look at my own account sometimes for a week, 2 weeks, a month. So sometimes it's a month because I'm so busy with my client account. Sometimes I don't look at my own account for like a month. I'm just not that concerned by day-to-day movements in the stock because I'm basically, when I turn 50, which isn't that far away from now, I really don't plan to do much in the way of work anymore, right? Meaning I will go to my jiu-jitsu academy and train jiu-jitsu, but I plan on having a bunch of other businesses that give me a little bit of money every month that I own an interest in and not really doing a ton of work. So my time horizon, when I came up with this plan, probably 10 years ago, my time horizon back then was 15 years or so. So why do I care what a stock is worth in 1 month? There's been plenty of times where a stock that I was investing in dropped 50%, and not only has it made all that money back, but now it's 100% higher, right? And you could have made a mistake by selling out, creating some sort of taxable event or something like that. Yeah. Min Tran says, can you check out FBRX? It's got a ridiculous price target of $800. That's one of the things I'll check out. Be sure, if you look at any of my other videos, put that in the comments. I'll make sure to do that. Yeah, I'll make sure to take a look at that. What's your top tip for finding the next Tesla growth stock? So a lot of people will ask me that, and Sheila's Joe, I got to say, being a nerd and being interested in the next greatest thing is one way to do that, but that's also one way to invest in a lot of things that'll end up losing money, right? There's a lot of, like I said, a lot of EV companies that are going public today are probably going to be out of business in 7 years, right? They won't be around. They will have been bought for pennies on the dollar by somebody else in the field, or they're just going to go out of business. So there's two things to look at. And really the thing that Kathy Wood says to look at is declining cost curves, right? That's curve of adoption, declining cost curves, and new technology. So it's important to understand the new technologies that you like and to understand how it can be applicable to a much wider audience than it is now, right? So the best example I like to talk about is the MP3 player, right? So I owned an MP3 player back in like 1997. It was called, or 98. It was called the ROmeo MP3 player. It was about the size of a deck of cards. It could hold like 60 songs on it. And I thought it was this great MP3 player. I went out there. I tried to invest in it. The company wasn't publicly traded at the time. I couldn't buy stock, but I was waiting for them to go public. Like I wanted to go out and buy stock in their company. The product never took off. Never took off. They beat the iPod to the market by like 6 years or something like that. The product, the market wasn't ready for it. People complained about the quality of MP3 recordings, which today no one complains about it. But back then, people complained about the difference in fidelity between a CD and an MP3. You don't even know that difference anymore. It doesn't even exist to people who listen to music anymore, right? But the thing is, it was an S curve of adoption. It just wasn't the right time to create that product to be successful, right? A few years later, and the only difference between the iPod and really the real player that I had, the iPod was about half as thick. It was about the same size and dimensions-wise, but about half as thick. It's enormously much more popular. The population had been primed to adopt the MP3 as a music standard at that point. Piracy basically it was music piracy that had exploded the popularity of the MP3 at that time period. And that's what made it the right time for and it ended up getting support for the music industry because Apple had a way to control what music went on there. So there was a lot of things that went into making the MP3 player by Apple more successful than the MP3 player by ROmeo, even though ROmeo beat them to the market by 6 or 7 years or something like that. That's the kind of hard thing to figure out. Like when I made my investment in Tesla, it was too early, right? And I was underwater for long periods of time. And really, I wanted Tesla to be successful. I wanted this future. But here's what I was also looking at. At that time, I was looking at putting solar on my house. And the price of solar panels kept dropping and dropping and dropping and dropping. The only thing that wasn't dropping was the cost of labor to put them on my roof, right? But the cost of solar panels was dropping at the time. And I had just gotten done reading Clay Christensen's book, The Innovator's Dilemma. And I was like, well, it's going to be a lot cheaper for me to put solar panels on my car at some point, or on my house at some point. And so I waited. I elected to wait. And then I started thinking about what other technologies were like that. And I looked at the cost of like lithium-ion batteries, and there wasn't a ton of research that was out there. And I remember there was an article that I read that said that when the Tesla Roadster was made, that lithium-ion battery technology price per kilowatt hour was about $1,200 per kilowatt hour, right? $1,200. Oh, and Min, thank you for the using the super chat features. I really appreciate that. Thank you very much. But anyway, back to that. So that was $1,200 per kilowatt hour. But just the demand of Tesla alone sort of tipped that lithium battery production over sort of a critical point where the price started to decline because the cumulative number of lithium-ion batteries at that point was doubling pretty quickly, and they kept declining and declining and declining and declining. So, so that I really invested based on the fact that I thought that the price to produce lithium-ion batteries was going to decline very quickly, which it did. But I thought that Tesla would have more competition pretty quickly too, which they do not, which is something that really surprised me. I thought there would be more companies popping up. Very, very surprising. But that's one of the things you want to look at is that sort of S curve of adoption, whether or not an idea is really going to catch on, and look at declining costs. Costs need to be declining pretty quickly for something to get adopted widely by the public, right? Let me see here. Love the thoughtful knowledge you bring. Any thoughts on Lemonade? It's a long play for me in my Roth. So I used to work in the insurance industry as well. I worked as a financial planner, and I worked as a programmer. But in both instances, I actually worked on the financial end, right? But I worked for an insurance company for a long time. And look, the insurance industry is also ripe for disruption at some point. A lot of the reasons that Lemonade gives for why they're better, like they're saying, oh, all of the other companies are not incented to pay on claims. Neither are they, right? They're not incented to pay on claims either. They have made a few things more efficient, but one of the things where they started is they really looked at that underserved market. That underserved market where they got their entry point was in renters insurance. Renters insurance really doesn't cover it's not expensive. It's like, I remember having renters insurance when I lived in Houston. It was like, I live in a crappy neighborhood in Houston, and my apartment got robbed like 3 times in 6 months. So renters insurance really paid off. In fact, the company had my insurance drop me because they thought that I was like staging robberies or something. Nope, I just live in a crappy neighborhood. But it's an underserved market, and renters insurance really didn't cover that much each time I got robbed, but it was enough to make the $20 a month I paid for renters insurance worth it, or maybe it's even less than that then. But even today, renters insurance is really cheap, but it doesn't cover very much. Lemonade did a better job of defining coverage to begin with. So they have better definition of coverage, and their cost of insurance, because they have better definitions of coverage and a really wide market at this point, they actually have a ton of users. Their cost of insurance is actually pretty low because of the areas they've decided to promote and spend in. They're offering renters insurance in areas that they know you aren't going to have a high degree of claims, right? And they're offering good rates in those areas that they know that aren't going to have a high degree of claims, and probably higher rates in areas where they think they're going to have a higher degree of claims, right? The other thing they say is they're doing everything by app. Millennials are comfortable doing everything by app. They say they have this advantage too. So that's only true to an extent. When I worked for another large insurance company that you guys probably, maybe you know about, maybe you don't know about, USAA, the company USAA, they also can do everything through an app. Now they have a full suite of folks available at their call centers. They have like 30,000 employees or something like that, and they have great customer service. But you can do everything through an app. Like the last time I got into a wreck, I got into an accident, I never talked to a person. I did everything through the app. You can order renters insurance, you can get life insurance, you get everything basically through the app. They're essentially doing the same thing. So they're not operating in a space that no one else was operating in, kind of like they try and make you feel like. But I do like the fact that Lemonade has been able to keep their cost of insurance really low. I wonder what they're doing on the back end in terms of reinsurance or taking some of that risk off of their books. That's what I'm worrying about. So, but Jonathan says, I think that The Innovator's Dilemma is the best book to look to convert people into growth investors. It is, but it's also the best book to look at why a lot of companies that were growth companies are now no longer growth companies, right? So The Innovator's Dilemma a lot of times talks about why some great companies have failed in the past. So CHPT, why do you think it keeps tanking? Steve, I haven't looked at that in a while. So yeah. Steve Hansen, same here. What's the going on with well? Why is ChargePoint tanking? I think people are coming to the same realization that I have come to with ChargePoint, is that number one, it got pumped up for not a really good reason. They have about 150, or last time I looked, they had about $150 million a year in revenues, which means they're a real company and they make real earnings, but they weren't worth their billions and billions of dollars of valuation. The problem is destructive competition in that space. It's going to be so easy for company after company after company to get into charging electric vehicles. That the real winner in charging is going to be probably the company that ends up tying all of those disparate networks together. Like if you look at just where I live in San Diego County alone, the last time I looked, there were 1,293 places you could charge your vehicle here in San Diego. Now, a lot of those were like the level 1 chargers, which are no better than your plug at your plug in your bedroom. But a lot of those were places where you could get a level 2 charger, and there was a bunch of and there were a couple of Tesla supercharger stations around too. But even there, I think there were 16 different charging networks just in San Diego alone, and PlugShare was the website that I went to that showed all that. The company that manages to tie all of those together in a single app, to where you use their app, you take your car, it doesn't matter which station you go to charge, it's all charged through the app, and everyone gets a share of those revenues. I think that's the company that's eventually going to win. If you're just selling the hardware, the technological barrier to entry for the hardware, like ChargePoint has, is really low. Right? It's really low. And so you're not going to make that much money by charging vehicles either. You're going to make your money based on the volume of customers that you serve, which means you have to have the fastest charging out there to serve the most amount of customers. ChargePoint has a lot of, I know they have a large network right now. The problem is it's an older network where you don't charge very fast, and you can't serve a large volume of clients. So a newer player will come in, and that's one prediction I'll make now. A newer player is going to come in and knock off ChargePoint as the top in EV charging. Just like AOL was a top internet company for a long time, right? And they invested so much money in the technology they had that served people that were on 14.4 modems and 56K modems, whatever it was. And then when broadband came out and a couple of other things involving the internet, they weren't able to innovate fast enough to keep up. They weren't able to make that turn around and make a reinvestment in new infrastructure to keep up. I think to a degree that's what's going to happen to ChargePoint, is that they're going to be pretty soon competing against just utilities. Like San Diego Gas and Electric has their own EV charging stations right now. I'm sure that other ones are going to do that. Yeah. Let me see here. What do you think about flying cars? No, we're not at the opening stages of an S-curve. There's a couple of challenges with flying cars. Number one, if my neighbor bought a flying car and took off from his house every morning and was moving that much air, I'd probably sabotage his car. I don't want to hear that. I don't want to hear that every morning, right? But yeah, that's one of the things. I think we'll eventually see some flying cars at some point, and there'll be a way to deal with that. But I don't think it's going to happen anytime soon. I would wait to invest. I know a lot of people are really excited about drone companies also. I'm finding it difficult for me to find an entry point into that right now. And I'll do more research on those before I say anything more, but I'm finding it difficult. Unique Mr. says, car insurances like Root, Metro Mile, are they going to disturb the car insurance business? I don't think they're going to disturb the car insurance business. I think that AI driving is going to disturb the car insurance business. What Tesla has already discovered is that non-human driving, as primitive as it is right now, is already better than humans. There are fewer collisions per 1,000,000 miles driven by AI right now, by full self-driving, than there are with human drivers. It's already better. Like, so for every story you hear of, a guy in a Tesla fell asleep at the wheel or a Tesla hit someone and killed someone that was under full self-driving, that's actually far less than is actually being killed every day by normal humans behind the wheel. It's already better than people. People are far less than perfect when it comes to driving. And I don't know why it's better. I don't know why it's worse to get killed by a drunk driver or a distracted driver on their cell phone than it is by a car driven by AI. But for some reason, public perception is it's worse to get killed or injured by an AI. I don't think that I think that's the problem, is the insurance industry is not going to have a way to price insurance, right? So now you use something called the law of large numbers to create a mathematical framework to determine what the cost of insurance is. With AI starting to drive now, and eventually, and that I don't know how long it's going to take for most cars to be driven by AI, but at some point, I feel like that's probably going to happen. And even if it's not like full AI, I think that once we get cars networked and talking to each other, we may not even need like level 5 autonomy. We'll have the cars talking to each other to avoid collisions in that respect. And I don't want to get too deep into those weeds there. But what I'm saying is there's not, for a period of time, there will not be a way to use the law of large numbers to determine the true cost of insurance, because we won't have enough numbers, right? The rate of accidents is going to decline so quickly, and we won't be able to determine what the price. So yeah, I think there's a lot of room for disruption in auto industry, in auto insurance industry, a huge room or amount of disruption. And I think that I haven't looked into Tesla's insurance side of the business all that heavily. Even though I like all things Tesla, I have not looked into their insurance. I do think even Tesla's insurance, I think this is what they are predicting, is that folks who have full self-driving capabilities on their Model S or something like that, because of the high value of their car and the fact that their driving is now going to be mispriced, that they would be paying far more for insurance than they need to. Far more for insurance than they need to. And I think that they're right. They're going to have an opportunity to make a lot of money in the insurance industry. Tesla will have a lot of money to make. So, and Steve Hansen says, I think I remember you talking EV charging not being much technology, but I was pumped by others. I proposed your video. All right. Thanks. I poo-pooed your video. Okay. Yes. Yeah. Look, like I said, Steve, it's not that charging infrastructure is not going to be built out. It is. The idea, though, is that the technological barrier to entry is so low, there's going to be 1,000 companies doing it, right? Or 10,000 companies doing it. I don't know. What do you think about EV flying taxi stocks such as ACIC? I don't think they're going anywhere. I think that so it's never popular to say that ARK is ever making a mistake, but a lot of times I don't know how much ARK invests in as a long-term investment strategy, and how much they invest in something, knowing that if they invest in something, there's going to be a short-term bump up in investor interest, and they're probably going to make money on it, right? I don't know that that is something that they consider. I really don't. But they could be, right? That could be a huge part of their strategy right now, is to exploit the ARK Invest bandwagon, because there is one, right? We're all on it. I think we are, right? We all admit that we're on that ARK Invest bandwagon. There's a lot of stocks that I've investigated and done videos on that I don't own, but the only reason I looked at them is because they're in the ARK Invest portfolio, and I found them interesting because of that. There's a number of things that I don't like about some of the picks that they've made recently. And these flying taxi stocks, why would you buy a flying taxi stock? Basically, I think that Tesla is going to be the first company that comes out with like a ride share or taxi stock or something like that. And I think they're going to be the first company that comes out with the software that's able to fly an airplane and have like a flying taxi at the same time too. I just don't think there's a reason to bet against them on that. I don't think that buying a flying taxi stock with someone who has an unproven self-driving technology, and we don't even have the VTOL battery electric VTOL capability at this point, at least not scalable at this point. So I would say it's really early to invest in those. I don't know why they've invested in them. I haven't seen their case for that yet. Maybe I'll change my mind if I see more a better case for that. So Unique Mister says, Jason, Root has a special discount with Tesla and offer a discount special on Tesla Autopilot. That's the first. That's really interesting, and that's what I'm talking about. That the auto insurance industry is already mispricing insurance when it comes to Tesla Autopilot and Tesla Full Self-Driving, and that's going to happen more and more in the future. This means less revenue for companies like Allstate, USAA, Farmers Insurance. All of these companies are going to have less revenue. Now, some of these companies aren't publicly traded; they're mutual companies, or they're reciprocal companies or something like that. So, Jason's video on Fisker. So I mentioned Fisker on one of my videos recently when it came to their discussions of solid state technology batteries, and I followed Fisker for the longest time, and when they kind of had their stumble and fell off the radar there, I lost a little bit of enthusiasm for anything Henrik Fisker. But I will say one thing: I've been looking into it a little bit more, especially after I read the article about why Fisker, dropped solid state battery technology for the time being. And even right now, you guys, I don't know if you guys saw that. So LG figured out a few weeks ago that they were being dropped by VW, and VW was dropping, at least for now, solid state batteries, and they're going with a prismatic cell, and they're going with a different manufacturer. And there's been this legal battle between SK and LG for a long time now in Korea, and they finally had a settlement, but the legal battle took its toll on some of its other business relationships. And when LG informed VW that they wanted to send an executive over to Germany to plead their case to keep the battery production in Korea, they were told not to bother to send their executive, that they'd already made the decision, and they had made this huge investment in this battery producer in Sweden, right? But they're also not dropping the idea completely of solid state batteries. They're just saying, we're going to commit to using this prismatic cell battery at this point. We're still developing solid state technology. They still have their investment in QuantumScape. QuantumScape has supposedly built like a 4-layer pouch cell battery at this point. And I said, I haven't really looked into the engineering specs on this, so I don't know the reason why they need to have 12 other than it's for the energy density purposes. And they also say that they've come up with a way to prevent the dendrite growth from piercing the barrier between the anode and the cathode, and to prevent the battery from shorting, which that I saw a white paper on that, and I got to be honest with you, I didn't understand that. I'm going to have somebody explain that to me so I understand it better. But yeah, so I'm still not a believer in QuantumScape, and here's why. QuantumScape is still overvalued at best, and this is what they just said a couple of days ago. At best, they're going to be able to produce enough batteries for a couple hundred vehicles by the end of 2023, right? So they have no revenues basically until the end of 2023. When they can make a couple hundred batteries for a couple hundred vehicles by the end of 2023, put it this way, they haven't even solved their technological challenges. So even that estimate, I think, is unreasonably unreasonably optimistic. But even in that case, they're still years away from profitability. I think they're 7 to 10 years away from profitability. I think there's going to be much better opportunities to invest in QuantumScape. And I think that everyone invested right now is going to be disappointed. I will invest in this company at sub 20 or sub $15 per share. That's where I will invest in QuantumScape. Let me see here. Part of me wonders if ARK Invest industry will really grab public imagination, flying tech trees, genomics, AI. I'm not sure what exactly you're saying. I think that the revolution in genomic medicine is something that we're not even going to think about as a revolution in genomic medicine 10 years from now. Like everyone's going to have medicine or medical treatment that is specifically tailored to their own genetic peculiarities. I think that's going to come here in the future. If you guys don't know, like I've been interested in this field for a long time since I took my own first DNA test, even though you guys heard that 23andMe is going public here pretty soon, right? And I know a lot of people have downplayed or poo-pooed the 23andMe and going public. 23andMe's business is not the business of telling you what your ancestry is. 23andMe's business is your genetic code. You are the product. Your genes are the product. The data that they extracted from your genes and the questionnaires you answered, that is their product, and they sell that to other companies, right? So the fact that people think that this is a company that does genetic testing and tests your ancestry and all that, and that's how they make their money, and those tests that has nothing to do with how they plan to make their money in the future. They're going to make their money in the future by being a data broker, right? That data is already immensely valuable, and that's the reason that they're probably their IPO probably will not do that well. That's that. I will maybe look at investing in them after a few quarters of financial. But I do think they're going to do really, really well. They've amassed a huge store of data. And they've done this from the very, very beginning. They may tell you about about 0.1% of your DNA. They tell you about that. They tell you about your ancestry. And a large part of your DNA is actually just everything that makes you human, not anything that makes you unique. But they've stored all of that. They have your complete genome. That is their product, your complete genome. And so that is the reason why, one of the reasons why we're going to see genomic medicine becoming more and more of a thing. As AI starts cracking the code on genes, on how they work, we're going to start first finding cures for these sort of like genes that are these diseases that are caused by a single gene being out of whack, or a single gene not working correctly. We'll find diseases for those first. And then later on, AI is going to figure out how genes work with each other, how a discrepancy in copying one gene affects the function of another. They're going to figure that out, and at that point, that's when we see more and more applications for this going forward. And so I think that you're not going to see these huge, bold announcements. It's going to be little by little, incremental changes, and sooner or later, we're all going in for genetic screening and genetic counseling. Yep. Let me see here. Jason or Mr. Unique says, I missed your comment on VW. They're really flying recently. Plus, VW is one of the largest in China. Yeah, they have about 14% of the market share in China at this point. They're the largest vehicle seller at all in China. Jonathan, you always have the coolest comments, man. But we're not. I'm not going to go into that right now. That's just a rabbit hole, man. So, do you think that NIO stock can outperform Tesla going forward? On a short-term basis, yes. I think on a long-term basis, no. They simply, at this point right now, they aren't really the innovators that Tesla is right now. And I know some people are going to be upset by that, but they're still imitators to a large degree as far as what Tesla is doing. Battery swapping isn't even a new idea. This is a company, and I just can't remember the name of the company, but there was a company that tried it. It was an Israeli company that tried it in Denmark, Israel, and here in California. They did it for a while, and it just didn't work because it was a little too early on that S-curve. And I don't think they're fully committed to battery swapping either. If you look at the way they make their battery swap stations, it's actually pretty genius. It's modular construction. They can put it together in 2 or 3 days. Now they can build it in less than 24 hours. And it takes 2 or 3 days for the electric company to come out and hook it up. So that takes longer than actually building the station does. And Xpeng is getting into making battery swap stations. They created a subsidiary that's going to create EV parts and battery swap stations. I don't know if that means they're going to produce vehicles that are going to have battery swapping capability. I don't know that that's what that means. It would seem like that's something that they're preparing for. But we don't know how quickly the infrastructure will be built out. So you have to go to China to understand the scale of construction going on, right? Even now, there's this hunger for things that are new. And everything that's being built that's new right now is going in with the idea that at some point you're going to add EV infrastructure. A decade from now, battery swapping may not be necessary or it may not be needed. Like if you can charge your battery up to 80% in 6 minutes, then you're basically the same thing as going to a gas station, right? So I think that 10, 15 years from now, things are going to look very different. And I think that battery swapping probably won't be around at that point. Yeah. So Steve Hansen said 12 is more layers to catch on fire. Well, actually, Steve, that's the kind of the point with the solid state battery. It's not using that flammable liquid electrolyte. So even if the battery is pierced, it's not supposed to catch fire. Even when it shorts out, it's not supposed to catch fire. So can you comment on what other sectors you like this year? I'm wondering if consumer discretionary would do well. Yeah, man, I think consumer discretionary is going to do very, very well. I think that financials will probably lag for a little while, but then they're going to start doing well. And they're going to do well in sale of products, right? They're not making a lot of money on deposit operations at this point because they're just not making a lot of money on deposit operations. They're going to make money on sale of products here coming soon. But no, I'm sorry, back to NIO. Can NIO outperform Tesla? No, I think that NIO is really limited to their basically being an EV producer, whereas Tesla is not, right? They're really going to be a major energy producer here in the future. They're going to have a major role in energy storage solutions in the future. I don't see NIO being able to do that at this point. So Tesla was able to build out this viable car business without a ton of competition. Now they're building out this energy storage business without a ton of competition. NIO is trying to develop in the face of lots of competition. I think they're going to have to concentrate on grabbing enough. So they're going to have a hard enough time grabbing significant share of the domestic market with companies like Great Wall and Geely competing against them. And they have the ability to just go to the market and buy whatever technology they want, right? NIO was not able to do that. They had to develop some of their own technology. And let's remember, all of their initial designs of tech was based off of the open source information that they were able to get from Tesla when Tesla released all of their patents to the public, right? And they built on that since then. They're not a copy of Tesla or anything. They're doing something unique, but they're facing a lot of headwinds. And I don't think they're ever going to be as big as Tesla. They're not going to be this $1 trillion company. If you look at Geely right now, they are one of the largest producers in the world. In China, they make about 1.5, 1.6 million vehicles per year. And, they're not even valued at half as much as, maybe not even as a third as much as NIO at this point. So let's see here. Mac Modi. When do you know if a correction has ended? The problem is, men, that you don't really know until after it's ended. So one of the things I like to look at when I see a correction ending is the volume of institutional purchases when something gets close to what I think is a bottom. When you start to see, guys like the pension funds, like state-run pension funds buying into that, and a lot of those guys, when they make large purchases, they have to publish that they did. When you start seeing a lot of insider buying of their own companies, that's when you know, or that's when you think that the end is pretty. The end of that correction is pretty much here. But look, there's a reason to believe that all of your tech stocks are overvalued, and most of them still are overvalued to a degree. And the fact that it just kept shooting up, that needed to stop at some point. They're pretty far ahead of their fundamentals. I think this year we're going to see a little bit of a retrenchment when it comes to tech stocks. We're going to see a lot of folks wait for fundamentals to catch up to values. I don't think we'll see too much more. So I don't think we're going to see too much more in the way of decline. I think we'll bounce around a little bit. And I think it'll go down from here and it'll come back up. But I think that probably next year and the year after that, we'll probably see technology take off again as fundamentals start to catch up with sort of the over-enthusiastic valuations at this point. So 23andMe merged with VGAC. I don't even know if it already merged. Sorry, I wasn't paying attention to that. So Solid state is 2030 for real production, in my opinion. I think that's probably correct. It's at least 2027, 2028 before we see solid state battery production. Although there's 2 companies in China right now that are already making, they're already producing commercial solid state batteries, but not for electric vehicle applications, for much smaller things. See delivery estimates or similar estimates here for Tesla for 2021. So they published delivery estimates, and I want to say that they were like something like 880,000 vehicles for the year is what they're planning for 2021. Don't quote me on that because I don't actually know. Shoeless Joe says $59. Is that today's price? $59 for QuantumScape? That's ridiculous. I wouldn't buy QuantumScape for anything more than $20. I really wouldn't at this point. And even now, like, I don't even know why I would do that. Let me see here. Thank you for your insight. Really appreciate it. So solar companies hit hard during this tech correction. I'm bag holding for SunW and solar stocks. What do you think about them? So here's a problem with solar stocks. It depends on, and I'm not all that familiar with those companies because I said I own an ETF that has all I want to invest in when it comes to solar companies, right? And largely because that industry is so commoditized, meaning that people have been producing solar panels for so long now that cost decline has gotten so steep that you produce solar panels very cheaply and you don't make a ton of money per panel. So it's all about the volume that you're selling, right? And competition is very, very fierce in that sector, and it's going to be difficult for anyone to break through and to become a billion-dollar producer, a new billion-dollar producer. It's going to be extremely difficult. It was probably a lot easier to do 10 years ago than it is today. So if you're expecting electric vehicle like growth in terms of stock, I don't think you can expect that. I think that the large players right now, unless something radically changes about the technology, and let's be clear, nothing has radically changed about solar power technology in a very long time. Right? There haven't been really huge improvements in efficiency in a really long time with solar panels. So unless something like that happens, I don't see a revolution happening with solar panels. I think it's going to be who can produce the more, who can deliver it the cheapest, and who already has the greatest amount of production capacity. Right? It's a business that's fully commoditized at this point. So I would have a hard time. Yeah, I don't own any individual stocks in the solar company because, like I said, I think that's something that's best owned through a broadly held ETF or something like that. I don't think you can achieve a level of return that's going to be satisfying for me to take enough. Like the risk that I've taken with Tesla, I've gotten a satisfying enough return to justify that risk. I can't imagine buying any of those solar stocks and getting the same level of return, right? So, okay. 23andMe and Ancestry, your comments. Thanks for 23andMe, but what about Ancestry? Ancestry, so I have accounts at both, by the way, Ancestry and 23andMe, and I really, their focus though has not been on collecting the same data, right? So I don't know what they have, and I don't know as much about their business because they were not developed originally. Ancestry was originally developed out of I don't know if you guys know, they're originally developed out of well, they're not owned by the Mormon Church, but it was genealogists who were connected to the Mormon Church who actually founded Ancestry and started that service. But they didn't start off as a biotech company or genomics company like 23andMe did. 23andMe's goal from the very beginning was to gather this data and sell the data to other companies, right? It was to provide you a service to get you to give them your DNA, so they could provide it to other companies, right? And that's part of the agreement that you signed. That didn't come along until a lot later for Ancestry. So they have a much larger database than 23andMe does, but I don't know what data they're collecting. So let me see here. So in regards to Xpeng, what do you think is a good entry point? Anything under 50, anything under 40, anything under 30? Honestly, like I would, at this point right now, I think that Xpeng is a pretty good buy. I really do. I think they're doing so many things that are right, just so many things that are absolutely right. And when you look at the growth in deliveries, you look at the growth in industrial capacity, they're building another factory. They've got all the financing they need. I really think that not at any price, but anything under 50 for sure is going to be a good buy. I would continue. And even by the time it gets to $50 a share again, they may be $60. I don't know, but we'll take a look at that. So any thoughts on AHAC, Humacyte SPAC Bioengineering? I don't know anything about it. I'm sorry. Yep. Jason, do we need battery swap? Would battery capacity be? Yeah, that's what I'm saying. We might not need battery swap here in the next decade or so. We won't need it. And as I'm saying, China, even in China, probably won't be needed as much in the next decade. Like they're building not just factories, they're building houses or housing at such a quick rate that I don't think that I think the infrastructure will catch up in a decade or so. Correction equals institutions milking retirement accounts. I don't know about that. There's a lot of fear. There's a lot of fear in any market, but there was a lot of fear like December, January that was unjustified fear about inflation. And Xpeng subsidiary just got about $77 million from provincial government. Quite an advantage for them. Yeah, but that's not the first time it's happened. They've got full backing from Guangzhou province. In fact, there's a giant development authority there that's developing something called the Knowledge Center or the Knowledge Park or Knowledge, whatever it is. Knowledge City is what it's called. And it's basically a giant technology development center where your research and development centers are going to be right next to your manufacturing facilities and prototyping facilities. And the city or the provincial government has taken on the role of actually recruiting talent and taken on the role of providing funding for a lot of these companies. They're basically creating a Silicon Valley in every region in China right now, and they're making a huge public investment to do that. We need to be making in the West the same public investment to do that, and this is something that we in the United States have not decided to do. Is when we decide to play. I back when this started in the 2008 timeframe, when the government decided they were going to play winners and losers in certain industries, and they've done this before in the past. This is not something unique or new, but they started this new round of it. I was not in favor of it at first until especially with the Solyndra thing and them taking $500 million in loan and going out of business. But when I look at the investments that other countries are doing right now in terms of investing in the future of technology, I realize that we need to be doing this too. And there are going to be failures. There's no way to avoid that. We're going to make some wrong bets here. Deepak says, question about retirement. Could you suggest any location in California? I'm looking to buy land for all kinds of farming or for all kinds of farming lot and weekends to get closer to nature and build a small house on the side. I don't know where you live in California. If you live in Northern California, I couldn't suggest any particular location. If you live in Southern California, there are, and the weird thing is I know a lot about gardening and farming too. You can grow anything in California, anything. Yeah, but Southern California land prices, I don't know if you can justify that. Like, I don't know if you can justify what you're going to pay for just to farm on the weekends. Like, I garden in my backyard and have figured out how to produce a ton. So, Shoeless Joe reminds me to remind you guys to like this video and subscribe to my channel, since I always forget to do that. Is IPO still cheap? Well, let's look at that. Okay. So let's look at the price of a couple of companies that went public in the last year, like by SPAC. So a bunch of EV companies went public by SPAC. They probably went public somewhere around $20 a share, $15 a share, and within a couple of months they were at $60, $70 a share, right? Or whatever it is. I'm thinking of Nikola. I'm thinking of I think where's Fisker? It's got to be north of 20 something right now. These are companies with no revenues whatsoever. Sofi had $680 million of revenue last year, anchored by their loan portfolio, which means that their financial services part of the business, this is all capabilities have added in the last 24 months or so. They're just getting started. Is IPO still cheap? I think it's woefully undervalued. And I think that you buy IPOE, it's going to be Sofi here in a month or so. And 5 years from now, I think you're going to be very happy with that investment. So I think the standing up of manufacturing is a sample of offshoring to come in the next few years. You mean reversing of offshoring? You talk about all the California EV companies that decided to build manufacturing facilities in Arizona. I'm not sure what you mean by that, Jonathan. You always have something interesting to say. So Okay, guys, I actually went a little bit longer on this live stream than I planned to today. And once again, I'm ending the live stream because I'm hungry. So that's always the reason. Oh, reshoring. Jonathan says reshoring. Yeah, I do. I think that's especially because automation, because a lot of these are smart factories now, and most of what you see working in there is going to be robots. I do think we're going to see a bit more reshoring of manufacturing, because labor is going to be a much lower cost of manufacturing. Yeah. But anyway, yes, thank you, Jonathan. I am going to end this here, guys. I want to thank you very much. And once again, super chat features were on. Mintran was the only one that used them today, so I wanted to thank him again. I look forward to seeing you guys. I'm going to be doing more research. It takes me a long time to do a video like I did for Sofi IPOE. It takes me 8-10 hours of research to do that, and then a long time to shoot, a long time to edit. So those are coming out once a week, maybe twice a week, those types of videos. And then my commentary during the week, which I spend less time on, I'm usually just commenting an article. I'll still continue to do those. I've not put out as many videos lately because I've been so busy with work. Between now and the end of April, because of tax season, and basically this is financial planning season too, I'm going to be so busy, it's going to be hard for me to put out videos. But anyway, thank you very much for coming on to the live stream. I really love doing these. I'm always nervous before I get started, but I really love it. So thank you very much, guys, and I will see you next time.